What's up, guys? Cameron's Gravel Boss here. Someone asked in the single axle dump trucks group how to prepare for taxes with his business. We're going to go into that a little bit. However, it's important to remember that I'm not a CPA. I'm not your CPA. And I could, in theory, not know what I'm talking about. However, I have been self-employed for 7 or 8 years now. We've had to learn the tax code quite a bit, and we play that game a lot. So we're just going to get into it. I'm going to go a brief overview kind of everything to kind of get you guys up to speed on the basics of how all this works. So, first of all, bear with me here, doing this handheld thing again. So you have sales tax, and then you have income tax. Okay, sales tax is a percentage of the total receipt. Generally speaking, this is like 1 to 10%, depending on where you live. I don't know what that is. I don't know what state you live in, but basically if you look up, like Washington state sales tax, then like it'll be like 9% or whatever. So like let's use 10% for simple numbers. Okay, so when you make a sale, let's say you buy, so for this whole equation, let's say you have a total sale of $500. $350 of that is gravel, and you're trucking, and you charge a $150 delivery. Okay. You are charging sales tax on the whole number. So you would charge $500 plus $50, which is 10% of 500 in tax. So the total bill that the customer receives is $550. Okay? $550. That's what the total price is, including tax. Now, because if you don't do that, if you try to include sales tax in it, the sales tax is actually still going to be charged on what the total sales price was, and it gets really complicated. So that's kind of the only way to go about it that I'm aware of, unless you just want to bite the bullet and like charge $600 and then you pay sales tax of $60 and you, or whatever. Anyway, okay, so that's how sales tax is calculated. Now, when you are buying from a pit, you need to have what is called a reseller's permit, because you shouldn't be paying the pit. On this $500 transaction, you bought $350 worth of gravel. The state is getting their sales tax of the total price from your sales tax collection, and when you pay that sales tax. So with a reseller's permit, the pit does not get sales tax from you. They don't collect it because you give them a copy of your reseller's permit. Give them a copy of your reseller's permit. They therefore don't have to charge you because you are already collecting the tax on their behalf, collecting the tax and submitting it on their behalf. Okay. However, you do have to charge for all of it. Okay. So, because you're going to get charged either way if you ever get audited for your sales tax. Okay. So after you get a reseller's permit, you submit that to your pit. They don't have to charge you sales tax anymore. The reason they are charging you is because you haven't provided them with a reseller's permit, and you're getting fucked both ways. So, okay, so this covers sales tax. This gets paid to your state or your city or like whatever it is. Income tax, being state or federal, I cannot speak to state income taxes because I do not live in a state with income tax. But I believe that it works similar to federal, if not identical. You are not paying tax. What you sell for me is completely irrelevant. However, you do have to track it. It's irrelevant for what you actually pay tax on, but you do need to track it. So this gravel that you bought here for $350 is classified as cost of goods sold. Sorry, my handwriting is so terrible. I have a struggle to do two things at once. Or COGS. That's what it's classified as. You don't pay federal tax on your COGS. You only pay federal tax and state tax on your profit. So put that down here. So you automatically are subtracting this $350 from the $500, and you're left with the $150 delivery fee. Out of the $150 delivery fee, you're going to have gas, which is a write-off. If you keep the receipts, you're going to have truck maintenance, which isn't tied to this job specifically, but it is part of, at the end of the year, you tally up, you're like, oh, I had I charged $3,000 of delivery fees. I put $1,000 into maintenance, $1,000 into fuel, or whatever. And then also you have all of your other operating expenses like insurance, etc. Any softwares, whatever. So this ETC. All of this at the end of the year gets subtracted from your gross profit. You can track this on your P&L when you have your P&L plus your balance sheet. So, which we're not even going to get into in this video because that gets complicated. So the only thing that you could potentially pay tax on would be your delivery fee and any upcharge that you had on this gravel. So hypothetically speaking, you could buy this gravel for $350, add a little bit. Let's say you add $50, so now you're actually charging the customer $400 plus your $150 delivery fee. Now you have $200 that you could potentially pay tax on. At the end of the year, you subtract all of these things, and you pay your tax based on what your actual profit at the end of the year was. You're not going to pay taxes on the $350. You're not going to pay taxes on gas, maintenance, insurance, softwares, etc. You only pay it on your net profit. Oops. But you do need but that being said, if you're charging a $150 delivery fee, you probably have $50 in expenses, pretty much guaranteed, just in gas. So you'd have $100 in theory of profit. You should probably take that 100, split it into thirds, or take the 150 and split it into thirds. You'd have 50. This is pretty common. Split it into thirds. 50 goes to the truck for maintenance. 50 goes to the driver for wages, be that yourself or another driver. And then 50 would go to taxes. And then at the end of the year, if you have done 100 of these, so you'd have $15,000 in hauling fees, you're probably not actually going to owe $5,000 in taxes, but you still want to save it. And at the end of the year, it's just like getting a tax refund. If you don't need to spend all the taxes. Anyway, but that's not for this video. So basically, cost of goods sold is never taxed federally because it's a write-off. Gas is a write-off, maintenance is a write-off, insurance is a write-off, softwares are a write-off, sub meals are a write-off. Any expense you incur along the lines of doing your business are a write-off and get taken out of your gross profit, become your net profit, and that's what you're taxed on, is your net profit. Hopefully that makes sense. Hope you guys have a great day. It's a beautiful day in Alaska, and go be a boss today. Also, you should totally subscribe to my channel. I'd appreciate that.